Good morning. Today is Wednesday, October 25th, 2023, and let's get started. I'm going to go ahead and summarize the news today, the business news. So on the front page, companies bail on Hong Kong. International companies, including banks, investment firms, and tech companies, are increasingly retreating from Hong Kong due to its growing ties to mainland China. The number of U.S. companies in Hong Kong has been declining, with U.S. companies being outnumbered by mainland Chinese companies in 2022 for the first time in decades. Concerns about Hong Kong's national security restrictions, Beijing's action toward foreign business, and the blending lines between Hong Kong and mainland China have prompted businesses to reconsider their presence in the city. While many companies don't plan on leaving China entirely, they are opting for locations like Singapore for their Asian hub. Despite the exodus, the Hong Kong government claims the city remains business friendly. Several global companies have left or are planning to leave Hong Kong. Additionally, foreign investment in Hong Kong's stock market is decreasing, with the Hang Seng Index dropping significantly. Beijing's stringent actions against foreign firms and imposing exit bans on certain individuals have added to the concerns. Some executives and travelers to Hong Kong now opt for burner devices for security reasons, a shift in the perception of Hong Kong's independence from China after Beijing implemented a national security law in 2020 has further strained the city's reputation. The American Chamber of Commerce has raised concerns about the increasingly blurry distinction between Hong Kong and mainland China in the eyes of U.S. officials. Despite this, Hong Kong insists on its unique position under the one country, two system principle. The financial landscape in Hong Kong is also seeing a shift. IPO volumes have dipped and major banks have reduced their staff. Assets managed by Hong Kong's private banks have also seen a decline. Despite these challenges, some believe that the city's potential for revival rests in its people and their ability to innovate and adapt. States accuse Meta of harming children. Attorneys general from 41 states and the District of Columbia have filed lawsuits against Meta Platforms, accusing the company of intentionally creating products with addictive features that harm young users, particularly on Facebook and Instagram. The lawsuit alleges that Meta misled the public about these dangers and knowingly targeted users under 13 years old, who are restricted from using the platforms by both Meta's policies and federal law. The states are demanding modifications to features deemed hazardous for young users. These lawsuits come after failed settlement discussions and a multi-year investigation led by Attorneys General Jonathan Skrmetti of Tennessee and Phil Weiser of Colorado. The legal actions were influenced by internal Meta documents disclosed by former employees Francis Haugen, revealing company research into potential product harms. Some documents indicated that a significant portion of teens with mental health vulnerabilities felt at risk using Instagram. Following these revelations, Meta halted plans for an Instagram version for kids. The lawsuits also highlight the company's response to these allegations, such as disbanding internal research teams. The attorneys general had previously engaged in discussions with Meta about a potential settlement to address these concerns, but talks broke down as Meta was allegedly unwilling to make significant product changes. High borrowing costs pose threat to resilient economy. Surging interest rates are emerging as a significant threat to the U.S. economy. The U.S. 10-year Treasury notes yield reached 5% recently, its highest in 16 years. Such rising rates, alongside other costs associated with long-term government debt, mortgages, credit cards, and other loans, might decelerate the U.S. economy, which has shown resilience so far. The economy is also facing challenges like potential energy price hikes due to conflicts in the Middle East, possible prolonged labor strikes, and a looming government shutdown. Despite these, the economy stayed robust over the last year, even with the Federal Reserve increasing short-term rates. However, a continuation of high long-term rates could heighten recession risks. Consumer spending, a significant economic driver, might take a hit, with rising interest rates further strengthening the dollar, negatively impacting impacting exports and pressing the housing market. Persistent high yields might strain the federal budget. The Congressional Budget Office projects the payments on federal debt could triple as a GDP share by 2053. The rise in interest rates could also increase the government's borrowing costs, potentially leading to a challenging cycle of debt. GM scales back EV plans as buyers balk. General Motors, GM, is scaling back its previously set target of producing 400,000 electric vehicles (EVs) by mid-2024, indicating growing concerns about the battery-powered car market's viability. This move was unexpected, especially since GM had earlier projected a shift away from gasoline-powered vehicles in the coming decade. Other companies, including Tesla and Ford Motor, also expressed concerns about consumer demand for EVs and their willingness to pay a premium for them. Recent challenges include the United Auto Workers strike, which began in mid-September, costing GM approximately $200 million a week in profit. Furthermore, sales growth of EVs has decelerated, leading to an accumulation of unsold vehicles at dealerships. GM CFO Paul Jacobson pointed to a market slowdown for battery-powered cars as a reason for the revised goals. Despite these setbacks, GM remains committed to its long-term goal of producing 1 million EVs in North America by the end of 2025. GM's early announcement in 2021 to phase out gasoline and diesel vehicles by 2035 had been well received by investors. The key question is whether these changes indicate an over-reliance on EVs by automakers or if they're just temporary challenges on the path to an electric future. GM CEO Mary Barra believes it's the latter, acknowledging that transitioning to EVs is challenging but expected. For the July to September quarter, GM reported a 7% drop in net income to approximately $3.1 billion attributed to the strike and increased warranty repair expenses. Nonetheless, this surpassed analyst estimates. While EV sales in the U.S. continue to outpace the overall auto market, the growth rate has diminished, and the pricing power of automakers has weakened. Earlier, EV models attracted premium prices, but now manufacturers are offering discounts to stimulate demand, impacting profitability. Tesla, the EV market leader, has reduced prices for its main vehicles, with other traditional automakers following suit. Elon Musk's Tesla's CEO has also voiced concerns about EV market outlook, citing high interest rates affecting consumer purchasing decisions. GM remains committed to an all-electric future and will adjust its EV production based on market demand. The UAW strike, now in its sixth week, has cost GM $800 million. Despite these challenges, GM reported a robust quarter, with average vehicle prices remaining relatively stable, indicating resilient consumer spending power. Lower heating bills forecast for winter. Ample supplies of natural gas and predictions of a warmer winter have led to forecasts of lower gas prices compared to last year, which saw high utility bills and increased inflation. According to the Energy Information Administration (EIA), the 60 million U.S. households that use natural gas for heating should anticipate average winter bill of $601, marking a 21% reduction from the previous winter's average of $764. While prices for electric heat and propane are expected to remain largely consistent with the previous year, households using heating oil might see a slight increase due to global market fluctuations. Natural gas futures are down 34% from the previous year, with the current gas storage surpassing the 5-year average by 5.1%. Last year, inventories were below average by 5.2% because of high exports and domestic demand during a particularly hot summer. Market predictions indicate that natural gas prices are unlikely to rise significantly by the end of the year. Increased crude oil drilling in places like the Permian Basin, which yields natural gas as a byproduct, has also contributed to the gas supply. Improved infrastructure in Pacific states, including the repair of a major pipeline and the reporting of a gas storage facility, means these states are better prepared for potential cold spells. In conclusion, Residents in the Pacific region can expect their gas bills to decrease by around 30% this winter. Microsoft's growth jumps as Azure unit thrives. Microsoft's revenue for the quarter ending in September increased by 13% to $56.5 billion, surpassing analyst predictions and showing an improvement from the 11% growth in the prior year. Azure cloud business of Microsoft saw a growth rate of 29%, which, although slower than the previous year's quarter, was ahead of the preceding quarter and analyst expectations, partly due to the demand for AI services. Microsoft's net income surged by 27% to $22.3 billion. They have been key players in the AI sector, significantly with their association with OpenAI's chatbot ChatGPT. Microsoft's capital expenditures in AI soared 70% from the previous year to $11.2 billion. The company is set to introduce an AI-assisted feature for Microsoft 365 named Copilot at a price point of $30 per user. Despite its success, Microsoft faced challenges including a series of layoffs and the acquisition of video game studio Activision Blizzard, which was met with legal issues. The latter's revenue is expected to constitute about 10% of Microsoft's total business. Sales of personal computers have seen a decline, and Microsoft's device business, including Surface computers, witnessed a 22% drop for the quarter. Banks face shakeup of rules for loans to low-income areas. Top U.S. banking regulators have modernized anti-redlining rules under the 1977 Community Reinvestment Act, CRA, which aim to prevent banks from denying or limiting services in minority neighborhoods. The current regulations, almost 30 years old, mandated banks to cater to everyone in areas surrounding their physical branches. With the rise of online banking and mobile finance, the updated rules now emphasize where banks conduct their business rather than their brick-and-mortar locations. While banks expressed concerns over the 2022 proposed version, believing it would be difficult to achieve top ratings, regulators have made adjustments in the final version to address these concerns. Michelle Brown, Fed Governor, opposed the final rule, stating there's no evidence banks are not meeting community credit needs. The rules were approved by the Fed, Office of the Comptroller of the Currency, and Federal Deposit Insurance Corporation. Banks have until January 2026 to comply with most new provisions. The CRA serves as a primary tool for the government to motivate banks to cater to low and moderate income areas. The updated rules arrive as the Biden administration seeks to address racial wealth and financial service disparities. The rules have seen contention between community groups and banks, with the latter believing they haven't adapted to technological changes. The effectiveness of rules in increasing low-income lending remains to be seen. Apple finds political risks in Taiwan ties. Apple is facing potential geopolitical risks in China related to its ties with Taiwan. Foxconn Technology, a major supplier for Apple, announced its collaboration with Chinese authorities following China's initiation of tax and land use investigations into the company. The timing is significant as Foxconn's founder, Terry Gou, is currently seeking the Taiwan presidency. The scrutiny of Foxconn was revealed shortly after Apple CEO Tim Cook's visit to China, introducing a new dimension of geopolitical concern for Apple and the region. Despite the reassuring dialogue between Cook and Chinese Vice Premier Ding Xuexiang regarding favorable conditions for foreign companies, the Foxconn probe underscores the broad spectrum of challenges Apple must navigate in China. The situation becomes even more complex against the backdrop of heightened tensions between China and the U.S., with Taiwan's status at the core of the conflict. Foxconn has stated its commitment to legal compliance, while Gou remains a controversial figure in the upcoming Taiwanese presidential elections due to his pro-Beijing stance. Experts highlight the inseparability of politics and business when dealing with China, emphasizing the multifaceted risks Western companies like Apple face in the region. Google's cloud sales disappoint. Google witnessed its most robust business growth in over a year, but its cloud sales disappointed investors, falling short of expectations. Alphabet, Google's parent company, announced a third quarter revenue of $77 billion, an 11% increase from the previous year. However, the cloud division's sales growth, which oversees the AI programs grew only by 22%, generating $8.4 billion in revenue. This resulted in Alphabet's shares dropping by over 5% in after-hours trading. Analyst Max Willens emphasized that the cloud computing sector is more volatile and that Google faces tough competition in this space. Nevertheless, the resurgence in advertising has benefited Google and other tech giants, enabling them to invest in artificial intelligence services. Alphabet CEO Sundar Pichai affirmed the company's commitment to leading AI models. Despite their ambitious AI endeavors, Google's search engine faces an antitrust trial in Washington, D.C. The company's advertising revenue rose by 9.5% to $60 billion, primarily due to more ads alongside search results. California suspends Cruise's license. The California Department of Motor Vehicles DMV has suspended Cruise's permit for autonomous driving, ceasing its robot taxi service in San Francisco. The DMV stated that Cruise's vehicles aren't suitable for public operation and accused the company of misrepresenting safety information. Cruise, largely controlled by General Motors, has been focusing on expanding its self-driving taxi service. However, the National Highway Traffic Safety Administration recently initiated a safety investigation into approximately 600 of Cruise's autonomous cars. Although Cruise has broadened its services to various U.S. cities, it has encountered issues in San Francisco, with its cars stalling and being involved in mishaps. As a response to the DMV suspension, Cruise paused its autonomous operations in San Francisco. Apart from halting its deployment of driverless vehicles, the DMV also suspended Cruise's testing permit. After launching its commercial driverless service in June 2022 using GM's Chevrolet Bolt electric vehicles, some of Cruise's cars started clustering at intersections, causing traffic blockages. The DMV mentioned that the suspension would remain until Cruise seeks permit reinstatement. The suspension doesn't impact Cruise's permit to test autonomous vehicles with a safety driver. The NHTSA has also been closely monitoring incidents involving Cruise vehicles. Recently, a woman was gravely injured after being hit by a car and then ending up under a driverless Cruise vehicle. Both the DMV and California's Public Utilities Commission regulate autonomous cars in the state, with the latter also suspending Cruise's authority to transport passengers in driverless cars post the DMV's decision. The Commission is currently investigating recent incidents and analyzing data from Cruise to determine any possible violations. UAW calls strike at large GM factory. The United Auto Workers Union has escalated its strike against Detroit automakers by organizing a walkout at one of General Motors' most significant and profitable factories in Arlington, Texas. Approximately 5,000 workers participated in the strike, targeting the plant responsible for producing high-profit margin vehicles like the Chevrolet Suburban, Tahoe, GMC Yukon, and Cadillac Escalade. This action followed GM's announcement that its third quarter net income had dropped by 7% to $3.1 billion. UAW President Shawn Fain, referencing the earnings report, claimed that GM's latest contract offer was insufficient in distributing profits among its workers. GM responded by labeling the strike as unnecessary and irresponsible, asserting that they had recently improved a previous contract proposal. This incident comes a day after nearly 6,800 UAW workers went on strike at a Detroit factory, representing the most significant intensification of the UAW strike action since its commencement in mid-September. 3M improves outlook after rosy quarter. 3M has raised its earnings forecast following a robust quarter, attributing the success to enhanced performance and cost management. The company, based in Minnesota, posted adjusted earnings per share of $2.68 for the third quarter, surpassing its own and analyst expectations. Their adjusted sales reached $8.02 billion, also exceeding projections. The company now predicts year-end earnings per share to range from $8.95 to $9.15. However, 3M faced a quarterly loss of around $2 billion due to one-time charges, including a significant settlement related to military earplugs. Although investors were initially optimistic about the company after certain litigation settlements earlier this year, concerns about a slow growth environment led to a 20% decline in its share price. The recent enhanced forecast led to a 5% increase in the stock. 3M is undergoing restructuring, planning to spin off its top-performing healthcare unit into a separate entity next year. Despite this positive shift, the company is under investigation in Belgium concerning PFAS water emissions from one of its plants. CEO Mike Roman emphasized 3M's strategy to concentrate on high-growth potential markets, including personal safety gear and advanced electronics. Coca-Cola benefits from higher prices. Coca-Cola saw increased earnings in revenue in the third quarter, driven by higher pricing and a minor uptick in sales volumes. In response to its current performance, the company raised its annual outlook, although it anticipates greater challenges from currency translation. CEO James Quincey indicated that inflation in the U.S. is decelerating and anticipates Coca-Cola's price hikes to further slow down towards the year's end and into the following year. The company's stock increased by 2.9% on Tuesday. For the third quarter, Coca-Cola's sales revenue went up by 8% to $12 billion, surpassing analyst expectations of $11.44 billion. Adjusted earnings, excluding one-time items, were 74 cents per share, which was higher than the projected 69 cents. The company now forecasts an organic revenue growth of 10% to 11% for the year, an increase from the previous expected 7% to 8%. Adjusted earnings growth is predicted to be between 7% to 8%, up from the prior 5% to 6%. However, the company projects a 6% impact on its earnings due to currency translation for the year. Sales for Gucci parent disappoint. Kering reported revenue of about $4.76 billion in the latest quarter, below expectations. Kering, the parent company of brands like Gucci and Yves Saint Laurent, reported Q3 sales below analyst predictions, highlighting a decline in the luxury goods sector following the post-pandemic surge. The company reported a revenue of 4.46 billion euros or $4.76 billion for the third quarter, a 13% decrease in reported terms and 9% down when considering a comparable scope and exchange rate. The luxury industry is facing global sales deceleration impacted by inflation, high interest rates, and economic challenges in China, previously the world's largest luxury market. Specific brand performances include Gucci with a 7% sales decline to 2.22 billion euros, Yves Saint Laurent down by 12% to 768 million euros, Bottega Veneta decreased by 7% to 381 million euros, and other Kering brands including Balenciaga and Alexander McQueen saw a 15% drop to 805 million euros. Despite these numbers, Kering's stock increased by 1% in Paris. Gucci, which remains a significant contributor to Kering's revenue, introduced Sabato de Sarno as its new creative director earlier this year. GE lifts guidance, sets company split in 2024. General Electric GE has increased its financial forecast and announced plans to divest its power business by the second quarter of 2024. Concluding the breakup of the industrial conglomerate, this decision will position GE's aerospace division as an independent entity, with both entities having separate listings on the New York Stock Exchange. Post-split, the aerospace unit will retain the stock symbol GE, while the GE Vernova power segment will adopt GEV. Following the announcement, GE stock value surged by 6.5%, marking its highest percentage increase since May 2021. Under the leadership of CEO Larry Culp, GE has sold multiple units, transitioning from a challenging phase to a major transformation. The firm also updated its annual revenue and profit expectations, citing robust jet engine demand and reduced losses in the renewable energy sector. GE reported a free cash flow of $1.7 billion, an increase from the previous year, and adjusted its full-year cash flow target upwards. The company's Q3 revenue rose by 20% to $17.3 billion. Snap returns to revenue growth. Snap, the parent company of Snapchat, saw its revenue grow by 5% year-over-year in the third quarter, reaching $1.2 billion following 2 quarters of declining sales. This growth was attributed to enhancements in its advertising platform. The growth defied analyst expectations of a 1.6% drop. However, Snap's net loss increased slightly from $360 million to $368 million compared to the previous year. Snap's reluctance to provide formal revenue guidance for the upcoming quarter is due to uncertainties from advertisers pausing their spending during events such as the Israel-Hamas war. Why? Snap anticipates its revenue growth to be between 2% and 6% for the current quarter, aligning with analyst expectations. CEO Evan Spiegel, well, that makes sense, expressed confidence in the company's advertising technology but recognized the need for improvements, especially for smaller advertisers. Apple's privacy policy changes in 2021 and a broader economic downturn impacted Snap's advertising revenue. In response to challenges, Snap reduced its workforce by 20%, halted non-essential projects, and introduced a subscription service, Snapchat Plus, priced at $3.99 a month. With over 5 million subscribers, Snapchat Plus provides an alternative income stream, although the majority of Snap's revenue remains advertising-based. Spotify swings a profit for the quarter. Spotify achieved its first quarterly profit in over a year, attributed to a price hike, a stronger advertising market, and effective cost management, accompanied by significant global subscriber growth. Spotify shares surged by 10% and its stock value more than doubled this year. Monthly active users grew by 26% to 574 million, surpassing Spotify's own projections. Despite introducing price increases in the US and other major markets, the company experienced substantial user growth with minimal customer losses. CEO Daniel Ek credited this success to the company's sustained investment in user experience, podcasting, and other service components. Premium subscribers increased by 16% to 226 million. However, the average revenue per user for the subscription segment declined by 6% to $4.63. This drop is due to Spotify offering discounted plans and reduced pricing in emerging markets, although it was somewhat balanced by recent price hikes. Total revenue grew by 11% to 3.36 billion euros, surpassing expectations primarily because of increased music and podcast advertising. Spotify reported a profit of 65 million euros, a substantial improvement from the previous year's loss of 166 million euros. This quarter marks Spotify's first profit since the initial quarter of 2022, aided by reduced expenses. Food halls conquer suburbs. Food halls, previously common in large cities, are seeing a rapid growth in suburban areas, benefiting from the urban exodus during the pandemic and the rise of hybrid work. These venues, offering a diverse array of gourmet and ethnic foods, target customers keen on artisanal and unique dishes, differentiating from traditional food courts, which focus on fast food chains. The U.S. now boasts at least 364 food halls, a significant jump from 35 a decade ago, with 120 more anticipated to open by next year. The trend, moving beyond major cities, is now evident in places like Omaha, Grapevine, and Selma, with food offerings from around the world. The pandemic has catalyzed this growth as food halls proved more resilient than the general restaurant sector. With more people moving to suburbs and adopting work from home, the demand for such dining venues has spiked. Developers and real estate firms are actively investing in these spaces, targeting broader demographics, especially millennial families, and aiming to provide more than just food by including entertainment options and events. However, there's some skepticism around food halls. Critics argue that they lack the personal touch of traditional dining and represent a significant initial investment for owners. While some food halls are still striving for profitability, others bank on supplementary offerings like retail, co-working spaces, and residential projects to turn a profit. In urban centers like New York City, food halls remain a staple, with new ones still emerging, representing the city's diverse culinary landscape. Europe leads way in green steel due to carbon taxes. Europe is spearheading the transition to green steel, with nearly 50 green and low-carbon steel projects expected by 2030, in contrast to the U.S.'s 2 projects. This surge in Europe is motivated by the continent's policies, including the EU's carbon border adjustment mechanism and carbon taxes. By the end of the decade, a quarter of Europe's steel demand will be met from low-carbon sources, while the U.S. will source just 10% from such projects. The EU's policy environment is propelling the continent ahead of the U.S. in low-carbon steelmaking. Demand for green steel has grown, with companies like H2 Green Steel receiving significant investment and supply agreements with major brands like IKEA and Mercedes-Benz. However, green steel will cost more in Europe, with some manufacturers planning to charge premiums. Surprise. According to this article, while Europe is progressing, the U.S. Inflation Reduction Act is incentivizing the establishment of low-carbon steel production. Meanwhile, China, which accounts for more than half of the world's steel production, primarily uses blast furnaces, a trend expected to persist due to their efficiency and their cost effectiveness. Real estate niche goes mainstream. The commercial real estate sector is witnessing a boom in the development of data centers driven by the increasing demand for artificial intelligence capabilities. Investment in data centers has skyrocketed, with Blackstone expanding its data center development from $1 billion to over $15 billion in 2 years. Major tech companies including Google, Microsoft, and Amazon Web Services have released significant capacities in North American data centers, surpassing previous records. Data centers which store and process online data require enhanced power and cooling systems, especially for advanced artificial intelligence computing. While other real estate sectors face challenges from high interest rates and decreased demand, the data center industry thrives due to the willingness of tenants to pay higher rents amid surging demand. However, concerns arise about sourcing the electricity needed for these centers, with environmentalists pointing out their potential environmental impact. One prominent location for data centers in the U.S. is Northern Virginia's Data Center Alley, but there are warnings of potential power supply delays until 2025. Banking and finance. Shares of two Chinese brokers soar. Futu's stock is now up more than 40% this year, a company booth at an event in Hong Kong. Chinese online brokers Futu and Fintech face challenges when Chinese regulators stopped investors from using their services due to violations related to overseas stock trading. Following this, their stock price dropped and their apps were removed from online stores. However, since then, Futu's stock has risen by over 40%, and Fintech shares increased by around 33%. Despite reduced trading volumes in the second quarter, both brokers experienced increased revenues, with a significant rise in interest rates playing a pivotal role. Higher interest rates in the U.S. and Hong Kong allowed brokers to profit by investing clients' funds in low-risk securities and benefiting from the interest rate differential. While previously relying on the Chinese market, both brokers have diversified, with Fintech seeing growth in regions like Singapore, Australia, New Zealand, the US, and Hong Kong. Futu, partially owned by Tencent, has also reduced its dependency on mainland China, expanding to overseas markets. Despite foreign investors pulling away from Chinese stocks, both brokers remained resilient due to their limited number of foreign shareholders. Existing clients can still trade using their app despite their removal from mainland China's app stores. Healthcare investors OrbiMed raises billions. OrbiMed Advisors has secured over $4.3 billion to invest in healthcare during a period where many startups find it challenging to obtain funds. Based in New York, OrbiMed accumulated over $1.86 billion for its ninth venture capital initiative, $1.71 billion for its fourth royalties and credit fund, and $751 million for its fifth Asia-centered fund. Although the investment pace by venture firms has decelerated, biotech venture funds remains attractive due to consistent innovation. By mid-2023, U.S. healthcare venture capitalists had gathered $13.7 billion, nearing the 2021 record of $28.3 billion. However, venture investments in healthcare have declined since the COVID-19 pandemic peak. OrbiMed plans on making comparable deals with its new funds as before, but will take bigger stakes and reserve more for subsequent investments. They aim to invest their new venture fund in 40 to 45 companies. OrbiMed's royalty and credit fund offers an alternative to equity, with royalty financing involving acquiring a share of a company's future revenue. Since initiating its Asia investment strategy in 2008, OrbiMed has witnessed opportunities, especially in India, despite a cooling biotech venture investment climate in China. OrbiMed has consistently yielded robust returns, making it an ideal time for experienced firms to invest. Barclays profit falls, eyes revamp. Barclays plans to restructure its operations following a 16% decline in profit in the 3 months leading up to September, further questioning its competitive stance on Wall Street. This decrease contrasts with the positive results from U.S. banks such as J.P. Morgan Chase, Wells Fargo, and Citigroup. CEO C.S. Venkataraman Krishnan admitted that Barclays lags behind its American counterparts and is formulating a strategy to decrease expenses and reallocate resources to boost its stock value. Barclays intends to present a detailed plan in February and is contemplating significant cost-cutting measures. The bank faces challenges like a downturn in deal-making, diminished trading, and fierce competition for client deposits, distinguishing itself as the only major British bank with a significant presence in U.S. investment banking. Its shares in London decreased by 6.5%. Profits in the corporate investments sector dropped by 29%, while income from advisory services and bond trading also saw a decline. Savings at its UK consumer bank also decreased due to factors like inflation and more attractive interest rates offered by competitors. The bank's net interest margin is under pressure because of increasing competition, leading Barclays to lower its margin forecast to between 3.05% and 3.1%. Regulators in the UK scrap bonus cap for bankers. UK regulators have lifted the restriction on the amount banks can award as bonuses to top performing traders and deal makers. This move aims to attract financial talent to London from places like New York. Since 2014, UK banks followed European Union regulations that cap yearly bonuses at double an employee's salary. Thus, bankers with a $500,000 salary could only receive up to a $1 million bonus. The Financial Conduct Authority and the Bank of England's Prudential Regulation Authority have now decided to abolish this cap effective on October 31st, permitting banks to grant unlimited bonuses from this year onwards. Originally, the bonus limit was Europe's response to the 2008 financial crisis with the intention of curbing risky trading and investment behaviors by bankers. Banks argued against this, claiming it led to inflated fixed salaries, resulting in high payouts even during underperformance. This change in rule reflects the UK's ability to diverge from EU regulations post-Brexit. There's a positive of Brexit. But it might face political criticism due to the role of major UK banks in the 2008 financial crisis. Stocks gain on strong corporate outlooks. Stock markets showed a positive trend due to optimistic corporate outlooks for 2023. Major indexes such as the Dow Jones, S&P 500, and NASDAQ Composite experienced gains of 0.6%, 0.7%, and 0.9% respectively. Wall Street is hopeful that companies can overcome a trend of declining profits over 3 quarters. The recent fluctuations in government bonds have impacted borrowing costs and influenced expectations about future central bank interest rate changes. The 10-year Treasury yield steadied at 4.84%. Major tech firms referred to as the Magnificent Seven mostly saw their stocks rise. However, Meta faced a drop of 0.5% due to legal allegations regarding addictive features on its platform. Both Microsoft and Alphabet reported gains, with Microsoft surging post-earnings and Alphabet dipping despite positive results. The upward trend in the market was witnessed across most sectors, with energy being an exception due to dropping oil prices. U.S. crude futures decreased for 3 consecutive days. Halliburton reported impressive earnings, but its shares decreased by 3.4%. Chevron stock also declined following its acquisition of Hess. Several corporations shared promising forecasts. 3M shares increased by 5.3% after raising its earnings outlook. Coca-Cola stock went up by 2.9% following a revision of its projections. General Electric shares surged 6.5% after a positive outlook and news of its power business spin-off. RTX reported $10 billion in new stock buybacks despite quarterly losses, resulting in a 7.2% stock increase. Verizon emerged as a significant gainer with a 9.3% jump after announcing it expects to generate $1 billion more cash this year than initially estimated. Despite the recent market optimism, some investors remain cautious, expecting a return to higher borrowing costs reminiscent of the period before the financial crisis. Internationally, the stock's Euro 600 grew by 0.4%. Asian markets also showed positive momentum, with Hong Kong's Hang Seng Index, Shanghai Composite, and Japan's Nikkei 225 experiencing gains. S&P 500 futures, however, declined slightly by 0.1%. Bitcoin rallies on high hopes for ETFs. Bitcoin's value rose significantly, reaching approximately $33,922 per coin on Tuesday. marking a 9% increase from its value the previous day, as per CoinDesk. The price briefly touched around 35,000. Stocks related to cryptocurrency such as Coinbase Global rose by 6.3%, and MicroStrategy saw a 13% increase. The rise is attributed to the anticipation of exchange-traded funds, ETFs focused on spot Bitcoin, as opposed to Bitcoin futures. The listing of BlackRock's iShares Bitcoin Trust by the Depository Trust and Clearing on Monday is viewed as an indicator of future trading approval. This surge in Bitcoin's price reflects values from May 2022 before a downturn in the cryptocurrency market. Several collapses and scandals in the market, including stablecoin value crashes and the decline of the FTX exchange, led to significant losses and calls for stricter regulations. Many see the potential ETF listing as progress towards establishing regulatory guidelines which should lead to more stability, liquidity, and broader adoption of cryptocurrencies in the future, as mentioned by Steen Jacobson from Saxo Markets. CAB slashes guidance, driving down shares after its prominent listing in London at a valuation of about $1 billion. CAB Payments saw its stock plummet by 72%, reducing its market value to around $175 million. This decline was prompted by the company's decision to reduce its annual revenue forecast and implement cost-cutting measures. CAB, which focuses on cross-border payments and foreign exchange in emerging markets, mentioned that shifting market conditions, particularly in some African currencies, negatively impacted their profit margins and trading volumes. Notably, they highlighted the instability of Nigeria's currency, the naira, which has seen significant depreciation this year. Despite its initially celebrated debut in London, CAB's stock performance has been underwhelming since its introduction, failing to exceed its initial public offering IPO price. JP Morgan and Barclays were the main coordinators for CAB's IPO. Genesis pays down debt. Digital currency group DCG, a crypto conglomerate established by finance experts Barry Silbert, has settled approximately $575 million of its debt since the close of 2022. This debt settlement was revealed in DCG's Q3 shareholder letter. Out of this amount, DCG paid around $225 million in both dollars and Bitcoin to its insolvent lending branch, Genesis. As Genesis's parent firm, DCG still owes Genesis roughly $50 million. This $275 million payment is part of an agreement that was settled between Genesis, a major group of creditors, and DCG in August. In addition, DCG reimbursed a $350 million loan to Eldridge, a holding company owned by billionaire Todd Boehly, in March. Notably, DCG, along with Genesis, Silbert, and the crypto exchange Gemini, are facing a lawsuit by the New York Attorney General accusing them of scamming over 230,000 investors out of more than $1 billion. Both DCG and Silbert refute these claims and plan to contest them in court. DCG's Q3 report also indicated a 23% yearly revenue increase, amounting to $188 million, excluding Genesis's results. This revenue is primarily attributed to Grayscale Investment, $126 million, and Foundry, $49 million. Heard on the street. Spotify hits all the right notes. Artist Alicia Keys at an event with Spotify earlier this month. Spotify's user base at year-end chart. Spotify's recent performance reaffirms its significant place in the music streaming industry. The company announced that it gained 6 million new premium subscribers in the third quarter, surpassing its earlier prediction by 2 million. For the upcoming quarter, it aims to add 9 million more, a figure higher than analyst predictions. By the end of the year, Spotify expects to have over 600 million monthly active users across both premium and free tiers. Despite a 10% price increase for U.S. subscribers to its monthly premium service, Spotify's user base did not shrink. This move came after competitors like Apple and Amazon had already increased their prices. The pricing strategy, combined with cost-saving measures from earlier in the year, led to Spotify posting an unexpected operating profit for the third quarter, its first in 24 months. As a result, Spotify shares jumped by 10% on a single day, while the company's stock has almost doubled since the year began, surpassing the performances of video streaming counterparts like Netflix and Roku. It still trades at a value of 40% less than its peak 2 years ago. One of the primary concerns for Spotify has been the music industry structure, with three major record labels holding most of the valuable music rights. Consequently, about 75% of Spotify's revenue goes towards royalties and direct costs. However, Spotify's strategic position cannot be understated. Streaming represents 84% of the recorded music revenue in the U.S. for the first half of the current year. Moreover, Spotify's U.S. listener base is double that of Apple, Amazon, and YouTube's paid services combined, underscoring its importance for artists and labels. Positive signs are evident in Spotify's financial metrics. Their gross margin improved by over 2 percentage points in 3 months, reaching 26.4% in Q3. This growth trend is expected to continue into the next quarter and the following year, even as the company introduces new offerings like audiobooks. Analyst Mark Mahaney of Evercore anticipates 2023 to be a turning point for Spotify's gross margins. If Spotify demonstrates its ability to manage pricing effectively and maintain strong subscriber growth, its shares are poised to climb further. Pfizer misses out on a biotech home run. Pfizer's decision to license a bowel disease treatment to Roivant has come under scrutiny after Roche acquired it for $7 billion. Roivant obtained this drug from Pfizer just 11 months prior, essentially for free. Pfizer had hoped Roivant would bear the drug's development costs, with Pfizer retaining a 25% equity stake. This move surprised many, given how quickly the drug transitioned between companies. During Pfizer's Q2 earnings call, questions were raised about whether this was in the best interest of Pfizer's shareholders. Pfizer justified the deal by highlighting their retained rights to the drug outside Japan and the U.S. and the associated equity stake. However, Roivant's subsequent profit was significant, with only $15 million in expenses against more than $55 billion in cash from the deal. Roche's acquisition includes an upfront payment of $7.1 billion for Telavant Holdings and a subsequent $150 million milestone payment. Although the treatment is still awaiting FDA approval, the potential of TL1A targeting drugs became evident shortly after Pfizer's deal with Roivant. A similar drug from Prometheus Biosciences yielded positive results, leading Merck to purchase Prometheus for $10.8 billion. These drugs are attractive as replacements for major drugs like AbbVie's Humira and Johnson & Johnson's Stelara, which are losing patent protection. Roche believes the drug could potentially tap into a $15 billion market in the U.S. for inflammatory bowel disease alone, with a broader application potential in other medical fields. Pfizer had earlier spent $6.7 billion acquiring Arena Pharmaceuticals, targeting an oral pill for ulcerative colitis, while Pfizer will gain approximately $1.4 billion from the Roche deal and earn from the drug's commercial success. The realization of missing out on a potential blockbuster drug, especially when facing diminishing COVID-19 revenue, may be a hard reality for its investors. There are reasons to worry about banks' business lending. Regional banks may experience a slowdown in business lending, a key offering for them. While there is significant attention on risk associated with credit cards and offices, the primary loans for many regional banks are to enterprises. These include commercial and industrial loans and loans secured by business-owned real estate. The credit risk for such loans is currently low, with the delinquency rate on business loans in the second quarter lower than the 2010 through 2019 average. However, stagnant growth can impact bank earnings, especially when deposit rates increase. Commercial loans, which typically have floating rates that yield more when interest rates rise, are essential to counterbalance these rising costs. Third quarter reports revealed a decline in total lending for larger regional banks, while both mega banks and smaller banks showed growth. Some banks, like Fifth Third and U.S. Bancorp, mentioned corporate clients' cautious approach due to uncertainties about interest rates and inflation. PNC Financial Services observed a decline in companies refinancing their credit facilities, awaiting better borrowing costs. Despite the concerns, many banks expect a surge in lending next year, asserting that their core clients are financially stable. However, with 10-year Treasury yields indicating prolonged higher rates, the demand for new loans might stay muted. In the past decade, with low interest rates, commercial lending grew significantly, surpassing U.S. GDP growth and outpacing consumer lending and residential mortgages. While this doesn't indicate an impending credit crisis, a prolonged decline in commercial lending can pose challenges for banks trying to counterbalance increased deposit expenses. KKR's chip play will win big in Japan. Private equity firm KKR has seen success in Japan with its acquisition of Kokusai Electric, a semiconductor equipment manufacturer. Kokusai recently raised about $720 million in Japan's biggest IPO in nearly 5 years. Having been owned by KKR since 2018 after its acquisition from Hitachi, the company's IPO valuation of $2.8 billion could give KKR a return exceeding 60% in Japanese yen terms. Kokusai specializes in equipment for deposition processes, specifically in batch atomic layer deposition technology, allowing for simultaneous processing of multiple silicon wafers. This technology is critical for memory chip production, with Samsung Electronics being Kokusai's major customer, accounting for roughly a quarter of its revenue. Despite challenges in the chip industry leading to a 21% decrease in Kokusai's net profit for the fiscal year ending in March and a 72% drop in the June quarter, there is optimism as investors anticipate a recovery in the chip sector next year. Other firms like Tokyo Electronic and Advantest have seen significant stock price increases. Compared to other Japanese chip equipment producers, Kokusai's IPO price valuation is relatively lower, trading at about 11 times its earnings. However, the company faces competition from larger rivals like Tokyo Electron and has vulnerabilities due to its significant dependence on memory chip producers and exposure to geopolitical concerns, especially concerning export restrictions aimed at China. Past geopolitical issues impacted Kokusai when an acquisition attempt by U.S. competitor Applied Materials in 2019 was stalled by Chinese regulators. However, investors might see Kokusai's IPO as a rare opportunity to invest in the chip supply chain's upstream segment at an affordable rate. Okay, that's it for today. Thank you for watching. If you lasted this long, I appreciate it. And please like, share, and subscribe to this channel. Turn on notifications. It's much appreciated. Have a great day.